I'm going to actually talk a bit about private equity and mining in Africa. I'm going to compare it to global private equity. And then I'm going to talk about sort of fund flows in the mining space in Africa. And then I'm going to paint a little bit of a picture about where things are currently and why this opportunity has been particularly attractive to private equity players in the last couple of years. So I'm not actually going to talk a lot about Tembo Capital, but I'm very happy to go through that story with anybody who wants to talk about that afterwards, if that's okay. So I think I'm going to start with actually my conclusions, and I'm going to work my way back to the introduction, because I'm not sure whether I'll be dragged off halfway through, depending on timing, etc. So I just want to make sure you get the conclusions in your mind. Yeah. A lot of money been raised in global private equity in the last couple of years. At least $21 billion raised. In Africa, the share in Africa is about 2.4 billion raised in Africa over the last couple of years. Important thing, emergence of Africa-focused private equity mining funds. So sector-based funds are on the map now in the mining space in Africa. A couple of years ago, you would have questioned that potentially. Private equity in mining in Africa has expanded from about 0.7 of a billion, which used to be largely DFI financed, into 2.4 billion now, which is largely financed by European and US pension and sovereign wealth funds. So how do we define, first of all, the space? So what I've done is I've taken that 21 billion, I've defined it into 4 different categories which relate to Africa, since we're talking about Africa. So Africa-focused funds, which are greater than 60 or 70% focused on Africa. Africa strategic, 30 to 60% focused on Africa. Play on a regular basis, in other words. Global mining private equity. Global mining funds which play in Africa occasionally. And then what I call M&A investing, which are large transactional-based funds. X2, for example, is one example, $3.5 billion. QKR, $1.5 billion. Magris, $3 billion. Really funds related to acquisition of assets in the mining space. So let's look first at global mining, and then we're going to look at, in a similar fashion, at mining in Africa. So you've got to compare the two. You can't do one without the other. So global mining and private equity used to be about 5 billion. I'm talking sort of 2-3 years ago, $5 billion. It's not a very big market. Private equity hasn't played in mining a lot in the past. 5 billion is now 21 billion plus. Yep. And as you can see from the diagram here, the Africa-focused, Africa strategic, quite small initially. That's actually doubled in size. What we call global mining private equity, it's gone from 4 billion to 5.2 billion, but by far and away the most capital has been raised for M&A investing, these big funds, which are what I call empire building type funds. There is a question mark as to whether those funds will actually yield private equity returns. And this is what you've got to think about when you're, as an LP if you like, if you're trying to invest in these things. So this diagram here are those 4 categories and the 21 billion shown on a diagram here. On the bottom, controversially with my colleagues, I've put management influence. In other words, as you look at it, on the left-hand side, high management influence. So in other words, the M&A companies who are buying companies, rolling their sleeves up, jumping into executive roles in those companies, that's where they sit. Halfway across, about what I call 70%, 60%, are the funds like Tembo, where we take board seats, we look for drag and tag rights, etc., as private equity players, some degree of control. And then on the right, there's less control, so it's a gradation. And then if you look on the far right-hand side, this is where the normal markets would play, yes, the normal capital markets, what are called hedge funds, in and out, trading in the stocks. In the current market in mining, they're not there. It's private equity that's the key player. In the red, you can see the Africa-focused private equity funds. Most of them in the category of board seats, dragon tags on the companies. The large blue circles are the M&A investing down the bottom. And then we've got the global and strategic private equity in the middle. I'm going to show you a similar diagram in a moment, which shows that for the funds which are in Africa. So, for example, Pallinghurst there, for example, and I think we've lost some of the numbers on that actually, some of the names on that. But Pallinghurst, for example, invests a large proportion of its funds in Africa. And so that will show up on the next diagram in a minute. So before we get there, what does African mining private equity funds look like? 0.7 billion in the past, largely DFI money. Africa focused around about 0.3, 0.4 billion. And the global mining private equity leaning in for a similar amount, just over that. So when we come to look at the new funds, 2.4 billion, all sizes of classes have increased. And this diagram basically shows that each one of the, and again, unfortunately, the names have not come out on the slide properly. You can see effectively here that there's an equal, all funds, all types of funds have raised. This is the map now of the mining private equity in Africa. And you can see here, this is the 2.4 billion and how it's spread. So the Africa-focused mining funds in red are a significant portion of the capital now that's operating in the mining space in Africa. That's the point to be made. So let's look at the size of the global industry, and then let's look at Africa, and let's look at fund flows. In other words, how important is private equity? Okay, so this data is taken from PwC. It's produced on an annual basis. It's the size of the market. The top 40, in other words. So it's about 85 to 90% of the market. As you can see, the blue line on the top there reaches 1.6 trillion. And that's the market cap of the 40 largest companies. Reached 1.6 trillion in about 2009, 2010. But you can see the size. If you want to measure the size of the mining space in terms of market capitalization, it went from 400 billion in 2003 up to 1.6 trillion, and then down to just under a trillion today, or last year. So the size of the mining industry changes over time. We'll answer that question why in a minute. You see in the yellow there is the revenue generated by the companies. And then on the bottom chart, with a slightly different scale, you can see in red the capex spend of the 40 largest companies, and then the net profit after tax. And you see how steeply the net profit after tax has fallen in the last few years. And that's why about half of the top 40 mining companies have lost their CEOs recently. That's why they've been chopped, because they've taken the eye off the ball. You see the capex spend continues to go up. The net profit after tax is coming down. The costs are going up. The actual prices of commodities are coming down. So they took their eye off the ball and they've got the chop. So this gives you an idea over the last 10 years or so, from 2001, it's zeroed in at 2001, gives you an idea of commodity prices and how they've risen. And this is largely the industrialization of BRIC countries, particularly the urbanization of China. And basically, you can see at the end of the diagram, you're roughly 3 times where you were in 2001. And it's this commodity price rise that's expanded the market caps of the companies and expansion of the size of the market. Let's look at some fund flows, generally speaking. So another way of looking at the market, and this is from Ernst & Young. If you look on the scale, US $1 billion, in yellow are the loans into the mining sector, the bonds, the convertibles, and then the equity. So the equity is grey and dark grey at the bottom. You can see how the equity has fallen off to 2013. Ignore the last 2 on the left. They're the half years to compare what's happened in 2014. But you can see the amount of equity being raised by the market's fallen off. The amount of convertibles has increased. The loans have remained. So the majors, because the prices of commodities have been high, have been really making good profits. The juniors, the mid-tiers, struggling to raise any equity at all. So if we look at it, the market size in terms of M&A, 140 billion is the size of the M&A market between 2005 and about 2012. It's come off in the last couple of years. Importantly there, you also see the Chinese M&A activity. Now, a significant portion of that is in Africa. Notice the scale difference there, though. You're talking about roughly 15 billion over a 4-year period, annually over a 4-year period. It's a very significant. So China's reaching out to buy assets overseas to ensure continuation of supply. So what about the size of the mining market in Africa? Turning to Africa now. My estimate of the size of the market in Africa is between 5 to 7 billion in 2013. That was about 10 billion about 3 years ago. The available private equity, as we've seen before, is 2.4 billion. So effectively, there's a funding gap currently of 2.5 to 3 billion. And this is why private equity is coming into play. There's a funding gap, and there's a really serious valuation opportunity because the mining cycle's on the bottom. So let's just look at a few of the parameters that define that sort of $5 to $7 billion market size. This is the exploration spend in Africa alone over the last few years. And you can see it's increased along with commodity prices quite significantly. Peaked at 3.5 billion, now about 2.5 billion. If you look at the African equity raised over the last 5 years, and you can see the light grey is the global one, and then you can see the different markets: Australia, London, and Toronto. Unfortunately, most of the money, 90%, 95% of the money north of the South African border is still foreign capital in the mining space. We had this debate on the first evening in the pub. Where's the local capital? There is very little in the mining space, unfortunately. What we need to see is more African money in the African mining space. This is just a quick slide to show you the M&A activity within the African mining space. This 2013, 2.9 billion. 2011, 20 billion. So it's come off quite dramatically. What about the debt? And here you can see total market, Africa in red. You can see relative to the total market. 2011, Africa raised 10 billion against 85 billion globally. 2013, Africa's 1.5 billion against 27 billion globally. So who's making the money? Which African countries are making the money? 54% of the revenue of mining projects is from South Africa. So South Africa still dominates in terms of revenue generated, dollars generated. Other countries now starting to pick up, but they're still a long, long way behind. The next one's only 6%. This is the map of where the revenue is generated in Africa, just to give you a sense of where mining activity is. You can see a lot of it in the CEDAC countries, in South Africa, Mozambique, that part of the world, Zambia, in the copper. Then up in the north, you can see a very large dot up there in Western Sahara, Morocco. That's phosphate. Yep. A lot of activity around in West Africa. That's bauxite, that's gold, and some alumina. This gives you a more granular idea of these are Australian listed companies. There are 220 Australian listed companies operating over 1,000 projects in Africa. This gives you an idea of where people are playing. People always ask me, what countries are companies prepared to go to? Well, this map gives you that idea and tells you what the mining operations are in terms of commodity. And you can see in both exploration and commodity, gold is by far the most dominant commodity in Africa. Coal is quite key. Iron ore is also quite key. So we look at Latin America here, and we look at Africa. Africa takes now 17% of the global exploration spend. And as we mentioned this year, it's 2.5 billion. So what's the current opportunity? Yep. This is the equity raised in the markets from IPOs in the last few years. And you can see 2013 almost zero. There is no equity available in Africa at the moment because of the mining cycle. Yeah, that's why the private equity players are seeing the opportunity. On the left is the Australian version of the same diagram. You can see the IPO raised down there, steep downward curve. Recently, 2014, virtually nothing. Some peaks, but virtually nothing. You look on the right-hand chart, that's the IPO in tech stocks. So where's the risk money? In the tech stocks, it's not in the mining. What happens over time? You see in the past, the black line are the tech stocks. When the tech stocks are high in 1999, mining in the yellow line underneath, the brown line underneath, low. Again, we're in a position at the moment where investment in tech stocks is high, mining is low. That's where the risk capital has gone. So there's opportunity in the mining space. That's why the private equity is there. Mining is a cyclical business, yes. These are the cycles. You can map them out over time. You can actually give reasons why they start. You can give reasons why they rise. And you can certainly give reasons why they crash. We've just started a new cycle now. This is the last cycle was 2009, 2013. You can see we're starting to get separation of the All Ordinaries Index going up strongly. Small mining cap index low, and All Ordinaries, which is the Australian All Ordinaries, which includes mining, staying pretty level. We're starting to see that separation, the beginning of a new cycle. So this is the opportunity. 2.5 billion now in Africa, 21 billion globally. Private equity is now a player in the mining space, particularly US endowment back now. This is new in the mining space. So thanks very much.
Could a generalist private equity firm just get up one day and invest in mining? How skilled do they need to be in that sector?
It's not so easy. I used to work with Actis and CDC as a specialist within a generalist fund. It's not so easy. And the reason is because mining is actually a fairly specialist area. But you can't, if you hire the specialist in, that helps, but you need specialism at investment committee level as well. You need to make the right decisions at that level. And so my colleague and I, John Hodder and myself, the two principals who set up Tembo Capital, we essentially came out of Actis CDC and now we've set up our own fund. And what we're trying to do is to be able to make decisions in the mining space, technical guys making decisions. We've hired an investment banker who's an expert in project finance to keep us honest. So watch this space in a few years' time. We'll let you know whether it works or not.
We have another question quickly.
Yes, a quick question. You highlighted how mining is a cyclical business, and certainly having a blind pool private equity vehicle helps in managing some of that volatility that you're likely to face. So in terms of timing, when should you start investing? How long will you be investing? When will you be looking to exit? And how does that match with what we've seen with previous cycles?
So obviously the best time to invest is when the cycle is down. If you're private equity money and you've got a long-term fund. So Tembo Capital is an 8-year +1 fund, closed-end fund. It started in April this year, and we're pretty much on the bottom of the market, as you can see. We're just seeing some equity raisings in Australia. We're just seeing the market start to come back, but the valuations are low at the moment. So this is the ideal starter fund. So when you're looking at private equity mining fund performance, vintage is quite important, actually. You can generally understand performance related to vintage. There are fund managers that outperform that, but I would argue that many businesses are cyclical. That's the way business works, actually, in practice. So if you realize that, start to understand how it works, and then try and invest accordingly.